So thank you to those that have joined. Hi, Raymond. I can see your little note pop up there. So we've got Lachlan Delahunty from Performance Property with us tonight. The reason we thought it'd be good to do a little update, especially on the Perth market, is, you know, there's a lot of uncertainty out there at the minute. Some people are nervous about the property market and what's to come. But Perth is also a little bit of an isolated bubble. So just because we're hearing a lot of stuff from over east doesn't necessarily mean Perth's in the same boat. So yeah, I'm going to hand over to Lockie, and he's going to give us a full update. Enjoy.
Thanks, Ali. I'll jump straight into it. So this session, I think we'll have about, hopefully keep it to 35 minutes because I understand it's late, but I'll give a little bit of an overview of what's happening nationally because it does impact sentiment on the ground here in Perth, unfortunately. But then I'll dive and spend most of the time this evening on the Perth property market update, and then just go through a few examples and what we're seeing on the ground, both in the investment space and owner-occupier space, and touch a little bit of what's happening in the commercial space as well. So macro speaking, it's interesting. We did a presentation similar to this back in June 2020. So in the midst of COVID, the market was very different to what it is now. So this was the property clock that we shared at that point in time. Fast track to where we are today, there's been a lot of movement and a lot of activity in the market. So if I go back to where we were in the middle of June, it's not too dissimilar in the sense that the time that we're in now is clouded a little bit with uncertainty certainly around the cash rate, interest rates, and global conditions. Not too dissimilar to where we were in June 2020. Some of the major banks at this point in time were forecasting anywhere from 30% to, sorry, my light's just gone off here, 30% to 40% negative growth in the markets across the country. And it certainly didn't prove to be correct. If anything, a lot of these banks probably got it 50 to 60% wrong. Our call at the time certainly wasn't to panic as it is at the moment, not to be forced selling properties, not to be selling properties in a time of uncertainty. At that point in time, we had a call to be purchasing Brisbane, Adelaide and Perth. Fast track to where we are today, the Brisbane and Adelaide markets were pretty well the highest performing markets, particularly in the residential sector. Adelaide receiving, from bottom to sort of the beginning of COVID to post-COVID, a 45% growth. Brisbane slightly under that at 39%, Perth at 22% growth. Sydney up 27%, and Melbourne was the lowest performing capital city at 18%. So looking to where we are now, there's obviously been some contractions in the market across pretty well all markets with the exception of Perth and Darwin over the last 6 months. Sydney median got as close to 1.3 mil as it had been, and since then it's contracted quite aggressively. Brisbane was the other market that has come off. It was hit sort of by a dual storm where they introduced the land tax to centralise all taxes on all investment properties within the one market. So that really sort of crippled that market, and then interest rates started to increase. So it sort of had a two-wave effect on that market, and Adelaide's been another consistent performer. So across the board, this is sort of what the capital cities are looking at today in terms of the median values. Obviously here in Perth, still extremely affordable in comparison to the other markets around Australia. So looking at a topical issue is the cash rate and obviously inflation, and that's dictating the cash rate. What this highlights here is two things. Obviously, interest rates are increasing, but the cash rate is still extremely cheap in comparison to where it has been previously. If you look back at 1990, the cash rate was at 12%. So where we are today, there's certainly a buffer there. But also what's true is when inflation goes up, obviously the cash rate goes up. But the same is true when inflation is tackled, and early indications at the moment is that is starting to trend down. We will start to see the cash rate start to reduce at a point in time. What you're probably reading, and what most people in Australia are reading at the moment, is headline media that's having a huge impact on the market. Sentiment does move markets and can do so for a positive result, as we've seen in Sydney. FOMO has driven that market in different cycles, but at the moment we're seeing the fear start to creep into these markets. We're seeing forced selling, and it's easy to get caught up in that. It's important to note that all markets operate in a different cycle and at different paces. At no point in history since we've tracked data back to 1980 has all markets in Australia been going through the same phase of growth or contraction at the same time. So if you look at Perth, it's always been a counter-cyclical in nature. When the East Coast has performed, we've underperformed, and vice versa. When we go through growth, typically it's correlated with the East Coast stagnating or declining. But what that media is reporting on is typically the Melbourne and Sydney markets. And I'm not saying that certainly Perth and other markets, Adelaide, Brisbane, are immune to rising interest rates. We're not. But the media are reporting on some pretty serious issues and issues that we agree with. And that's that the Sydney house bubble or the house market is certainly unaffordable and will potentially continue to contract due to this affordability issue. The reason the market is so sensitive to cash rate is because the cost of money as it becomes more expensive and the affordability issue in Sydney have always correlated because the market is unaffordable. So at the moment, the affordability index in Sydney is at 75%. So that's assuming a variable rate, understanding that a lot of the loans across Australia are on fixed, but are starting to come onto variable rates over the next 2 years. At 75%, that market has never been at a threshold where 75% of the average wage is consumed by the average mortgage. So that is, for us, serious concern, and why that market has never entered the depth of that sort of level before. So typically, when we look at affordability, the market caps out at about 66%. That's a historical ceiling for Sydney. At 75%, we're 10% above that. So this market, to return to its historical ceiling, would have to contract another 10%. It's already contracted 12% in the last 12 months. It would have to continue to contract another 10% before it reaches that ceiling. Even at that level, it's not an affordable market. It would have to contract somewhere between 15 and 20% before it gets back to sort of in the threshold limits of 50 to 55%. So that's why we've got some growth concerns for that market. Looking at other markets from an affordability point of view around Australia, Melbourne's starting to hit its ceiling now at 53%. Another interest rate rise would put it past its historical ceilings. Therefore, we still think there's some contraction in the market. Maybe modest in comparison to Sydney, but certainly not a market that's going to go into a period of growth in the foreseeable short-term future. Brisbane, we're still, what are we, at 45%? So we're 13% from our historical ceiling. So the Brisbane market, like I said, it was sort of a dual issue there with the land tax problem that occurred mid to late last year, as well as the rising interest rates. We have seen some contraction in this market once interest rates level out, which could be as early as the next 60 days. It could be as late as middle to late this year. But at some point, interest rates will stagnate. It could be here based on what's happening in America last week. It could be here before we know it. Once that occurs, we think Sydney will start to get confidence back in the market, and we may see some modest growth in that market. And I'll talk through probabilities later in the presentation of where we see these markets returning to once interest rates level out and potentially decline. Good old Perth over here, we're at 29%. So there is obviously a positive news story in Perth is the fact that prices have held strong through 10 consecutive rate rises. The reason is, there's a lot of fundamentals that have underpinned that level of strength throughout some serious times of uncertainty. But the fact that we're not as sensitive to the cost of money is because we don't have an affordability issue. At 29% in comparison to Sydney at 75%, we're sort of halfway from our affordability ceiling to where we were back in 2008 at 59%. So even with another 1, 2, 3 rate rises, the market is comparatively affordable and can still sustain growth within the market before it becomes unaffordable. So we're not forecasting growth in a rising interest rate environment, but certainly we believe we're well and truly over the hill of that environment and potentially about to enter a stagnation period. The next movement from there will be a reduction in interest rates. Once that confidence comes back in the market, based on the data that we're about to share, we think Perth will start to move into its second phase of the growth cycle. Obviously, we've come off 2 to 2.5 years of pretty modest growth, 20 to 22%. Phase 1, we're about to enter phase 2 of that over the next 6 to 12 months. What may cushion some of the declines in the national environment is record low vacancy rates and stock on market across the country. So yes, we are forecasting falls in Sydney and potentially in Melbourne, but what may cushion a 10 or 15% fall in Sydney house prices is the fact that there's minimal stock available to purchase on the market, but also in the rental space as well. This will cause an increase in yields, increase in rents, which will then sort of offset the burden of higher interest rates, which will put a cushion. And what we're seeing is dwelling approvals across the country at the moment. When you look at houses, units, and also the dark green line at the top there, we're just not building enough property. So we're almost at a decade low in terms of how much property we're building because of obviously supply chain issues with materials and labour shortages across the country with record low unemployment. What that's going to do to the market that's got a rising population, as you can see, we're now starting to return to some positive overseas migration. That's the green line there. So we had 2 years of no overseas migration. So we're going to start to see these numbers return back to a normality. Obviously, we got a share of immigrant into the country last year. So we've got a rising population from overseas migration, but we're just not building enough dwellings, which is going to put pressure both in the rental space, but in the purchase space or the sales space as well, which may cushion some of that national decline in market conditions. Looking at Perth, and this is where I want to spend the majority of the presentation, it's a different news story, right? So easy to get sucked into headline media and what's happening on the East Coast. And, even some of the experts listening to some real estate agents locally, they start to believe what they read. But when you dive a little bit deeper into what's happening here in Perth, it is a different news story. And there's a reason for that. Looking at the Perth cycle, and this is what we did throughout COVID, right? When COVID hit, we went through the last 5 previous economic downturns and what that did to property prices. Because everyone, during a period of uncertainty when COVID hit, everyone was forecasting 30-40% declines. When we actually look back to the GFC, dot-com crash, etc., the opposite actually occurred. What happened is the government started to stimulate the economy with spending, interest rates come off, and across the country, nationally, we've seen actually prices rise quite aggressively, that's actually how it played out in COVID. Same is true when we look at Perth and the correlation between cash rate. It has never correlated. So if we look back to when we saw growth in the market, so this is the Perth median house price since 1980, and there's been 2 clear, distinct periods of growth and 3 clear periods of stagnation. Periods of growth were from 82 through to the 90s. 1990, where prices went up from 30,000 to 90,000, followed by a period of stagnation. And then we've seen the market really kick again from sort of 1999 through to 2006, followed by another stagnation period. If we correlate that for where the cash rate and interest rates have increased or decreased, obviously in the early 90s, interest rates, the cash rate went from 4.5% up to 8%. So a lot cheaper than what the cash rate is today. That was through the first cycle of growth. Same thing occurred in the 90s, mid-90s, when we've seen cash rate go from 5% up to 6.5%. That was also correlated with the period of growth, so out of cycle to the rest of the country. Same was true in the 2000s, 2002 to 2007, where prices went up by 200%. It was throughout a rising interest rate environment. And the same should be true when interest rates were coming down from 5% down essentially zero. Prices in Perth contracted. So the rest of the country obviously benefited from that and went through a period of growth. Perth did not. So I'm not saying we're immune to rising interest rate environments, but this is what's playing out in the market at the moment, where we're seeing stagnation across the macro market, but we're seeing prices rising in certain pockets of Western Australia at the moment. So looking at the overall summary in terms of key market indicators, supply and demand, affordability, confidence, money supply, investment value and risk, Perth remains a very positive market. And from an investment standpoint, from our national business, a market that we will take a strong position over the next 12 months. And a lot of our East Coast clients are on board with that strategy, understanding what's happening on the East Coast. We're seeing markets contract. Perth is where we're probably seeing the best value in the country at the moment, with the exception of Darwin. Understanding Darwin is a slightly more volatile market, and it carries higher risk with insurance premiums. Therefore, it's only suited to really sophisticated investors. From the demand side of the equation, Perth locally, we have, sorry, I've just got someone who wants to join, so we're going to have to bear with me. We're back in. From the demand side of the equation, we have population growth and quite strong population growth, both from overseas and interstate migration. The problem with what happened from 14 to essentially COVID was we were losing too many people to the East Coast, and overseas migration wasn't strong enough. What we've seen for the first time last year for the first time in essentially 7 years was both positive overseas and on interstate migration. So we had just over 10,000, so 12,000 people moved to Perth or WA from interstate, and 10,000 people from overseas. So about just over 20,000 people come to WA to live here to work. What we're forecasting this year is similar figures, but probably slightly inflated. Early forecasts suggest that we could probably have anywhere from 24 to 28,000 people come into the state, predominantly for that employment and heavily in that sort of mining sector where they're higher paying jobs. So coming to Perth, unemployment is the lowest it's essentially been at 3.4%. Underemployment is trending down from 5.5, which we're getting back to sort of, the data that we haven't seen since sort of the 70s and 80s. More compelling is we've got job vacancies now, as we are here in March 2023, over 60,000 job vacancies in the market. So think of SEEK, think of the combination of job advertisement across all boards. Typically a balanced market for Perth is about 25,000 vacant jobs in the market, currently over 60,000. That's significant. And when we look at how many people are currently unemployed, which is obviously the black line above there versus the job vacancies, for the first time in history, we could potentially over the next 6 months see these overlap, which hasn't happened in any market across the country, let alone Perth. As you can see, since 85, the gap between unemployment and job vacancies has been quite significantly vast, and we're starting to close in on that for the first time really in history. What's also important to note is a lot of these job vacancies, 5,500 of these job vacancies are high-paying jobs, so jobs that exceed $150,000 incomes. Why that is significant is because that encourages migration, East Coast migration. You get people in the trade sector on $90,000 a year. If they work weekends, $100,000, they can move across for $160,000, $170,000 to work 6 months a year. That becomes significant enough to want to move, therefore coming into the market where they can. Sorry, Ellie, you've got something here. Got a note for the presentation.
We seem to have lost the presentation when you joined the last person.
Good to know. Thank you. I'll bring it back.
Thank you.
So just sharing my screen again. Let's go. Tell me when that comes back on your screen. Be back on?
Here we go. It's coming on now.
Yep. Job vacancies.
There we go.
Right. So I've just been doing a lot of talking and you haven't been able to see much. So essentially what I was saying, there's been strong population growth here in Perth. I'll just backtrack a little bit, which you've heard me speak about. The data's there. Low unemployment, low underemployment, job vacancies now exceeding 60,000, correlated with, like I said, the first time really point in history where we're going to see job vacancies actually exceed the number of people employed in the state, which is significant. But when we correlate that with the supply side, so a lot of people move into WA for work specifically, we need the properties to house them. And the issue that we're going to see is there's just simply not enough properties available now or in the next 2 to 3 years when you look at building approvals to actually house this population growth. So days on market now at 15 days, the lowest it's been over the last 15 years. And it really can't get any lower than that because agents need to get some promotion in the market. They need to put properties online. Therefore, they typically run for a minimum of 15 days. But the stock on market has dropped from 17,000 down to where we are today at 7,500 properties available on the market. So almost halved. And when we look at stock on market for the rental supply, it's dropped from where it was there on the orange there from 7,500 back in 2019 down to about 1,700 properties available in the rental market. So we've got about 9,000 properties available in Perth for someone who's looking to reside here from either overseas or interstate. 22,000 people moving into the state this year doesn't go into 9. So the other solution there is we need to build more properties. But unfortunately, when we fast track to that, we're only building under 3,000 properties a quarter. So about 2,500 to 3,000. So net that out, we're building about 10,000 to 11,000 properties this year, which is certainly not enough to offshoot, obviously, natural increase of people that leave home. If we're looking at population growth in generally, there's typically more people, less people per dwelling, so more individual dwelling, but also correlated with that immigration. We're not going to see enough bedrooms being built for the population growth that's occurring within Western Australia at the moment. And that's the vacancy rate across the board. So looking at vacancy rates, we've got a peak of about 6% back in 2016, and then obviously that's come off quite significantly down to 0.4% where we are today. So looking at where the markets are, like I said, the summary, Perth here is very much at the buy value of the market. We've got the Melbourne and Sydney market very much at the top of the cycle and starting to stagnate throughout that downturn in the market. We are of the belief that Perth is, as I said, we've gone through a very early phase of growth that's occurred over the last 2 years, phase one, but into phase two of that next cycle. And other markets in a similar position, like I said, the Darwin markets, Toowoomba, Mandurah, Rockingham, Rockhampton, Bunbury. So very much a strong Western Australian presence there. Markets that are progressing through that cycle, Adelaide, Brisbane, we are forecasting growth, and I'll go through the probabilities here as to where we can see these markets getting. So currently, cash rate at 3.6, the likely variable rate of 5.4. This looks at the probability based on historical ceilings. So if Adelaide, Brisbane, if these markets are to be at those historical ceilings, Adelaide, once interest rates level out, has 19% growth left in the market. Brisbane 35%, Canberra 4%, Darwin 55%, Melbourne 7%, Perth 101%, Sydney negative 10% or negative 9%. So it's not to say we're forecasting 101% growth in the Perth market, but for us to, on today's cash rate, to reach our historical ceiling of where we've been to in the past from an affordability point of view, Perth house prices would have to double. And then obviously here's our price forecasts. If interest rates are to stagnate and come off, there is some experts in the market now forecasting rate reductions next year, and quite a few. If we assume a cash rate at 3% and a likely variable rate of 5.2, obviously the markets across the board look more favourable. And then there's obviously price forecasts for 4%, 5%, far less favourable, and hence why we're not forecasting a cash rate to get to a 4%, because based on that prediction, Sydney would then come off 17%, and it's already come off 12% over the last 12 months. That would be significant, closing in on a 30% reduction in house prices. I don't think the RBA or anyone in Australia wants to see that. It could throw the market into sheer chaos and potentially a housing recession in the Sydney and East Coast markets. Investment principles, I will push through this quickly, but again, our fundamentals remain the same, and that's buying AAA rated suburbs and buying A-grade properties. What does that look like? A-grade properties is established houses. Typically, we want to be buying properties with stronger land value. Ideally, if you're looking at a residential portfolio, we want 70% of the value to be in the land of those assets, certainly not in the improvements. We avoid house and land packages, apartments, units, or anything that's compromised. When we talk about compromised stock, we are talking about things with due diligence issues. These can be anything from zoning council overlays, flooding, housing commission, easement problems. Most commonly, we see this with adjoining uses, so buying close or within proximity to apartment zoning, commercial zoning, things of that nature. Obviously, sales frequency, moisture. There's just a lot that needs to go into the investigation when looking at investment. Certainly don't take any shortcuts in this space. Where we're investing for our client base at the moment, 37 buy suburbs across Perth, based on our local data, so looking at growth rates, vacancy rates, stock on market, days on market, etc. Obviously overlay that with infrastructure spending, school catchment areas, average incomes, etc. That is the foundation of, I suppose, the micro data that underpins our 37 buy suburbs locally. Elective due diligence, again, you can never be too cautious when buying property. What we see more commonly in this space is people going out there and buying properties with non-conforming structure uses. Sitting here in our office in Subiaco, it's probably one of the most renowned suburbs for non-conforming structure uses. A lot of the granny flats or ancillary uses, studies, etc., may not have council approvals. That can be really problematic and costly. So it's just important, when buying a property, making sure everything's got council approvals and getting electric orders, etc. So we will not compromise on these due diligence items, nor will we compromise on these due diligence items when looking to buy either that primary place of residence or investment, because you can start to run into problems and costly problems. Portfolio examples. This is historically what we've been able to build for our clients. Won't go through that in too much detail today, but the key things to note here is diversification in the portfolio. So as you can see here, we've got a mixture of Queensland assets, South Australian assets, Victorian assets, Western Australian assets, both here in WA as well as regional. But more importantly here over the suburb rating and more importantly the property rating, looking for that A-grade quality within the portfolio within AAA rated suburbs, keeping really consistent and ensuring you stick to those principles. So yeah, different portfolio examples. Again, happy to share them outside this. In the home buying space, winners and losers, obviously this is typically at our Western suburbs market. What we've been able to do here for clients in the last 2 years, what's important to look at is more so around the 5-year growth rates. Obviously, peppermint growth showing negative 23% growth in the market over the last 12 months isn't what's happening on the ground. Very much a low stock market with very low sales volumes. Therefore, 1 or 2 sales skews that data quite substantially. But looking at the 5-year growth rates, the winners have been certainly Subiaco at 7%. That's compounding growth year on year for the last 5. Flory at 7.8%. City Beach at 8.2%. And for our clients that have purchased there in the last 3 years, have done well in those markets. Obviously, these markets are very competitive and dominated by off-market transactions. In the commercial space, it's been an interesting 6 months, and I suppose the data that comes through here, we've seen transaction volumes down significantly. We're starting to see yields expand, and as the cost of money goes up, obviously yields need to expand to do that across different sectors in different markets. So we haven't seen this play out yet because we've seen sales volumes essentially reduced dramatically in this space because you've got sellers at one level that have purchased in the last 5 years on yields of 5, 5.5, 6, and we've got buyers entering the market trying to get in at 6, 6.5, and 7 based on the cost of money. So there's a gap in the market at the moment, which has resulted in certainly lower transaction volumes. In the medical space, commercial space, primary place of business space, again, we're seeing low stock levels. We're seeing clients finding it difficult to locate stock. Fortunately, we've had some wins in the last 6 months in the off-market space, trying to bring about different opportunities for clients. But again, anyone in the market for this is probably finding it quite difficult because there has been certainly some contractions in pricing, and we're probably seeing more value in that owner-occupier or primary place of business space, more so than that investment space at the moment. So that is enough from me. You don't need to sit there and look at my ugly mug, but any questions that need to be answered, certainly happy to answer them now in the comment section and or reach out direct. There's an opportunity, I suppose, there to grab my details if you wish to email me privately. So I will just leave it there for that reason and that reason alone. But certainly feel free to reach out at any point if you've got any questions. Or if Ellie, you want to jump in with any questions.
Yeah, I've got questions. So if someone, would you still encourage people to be investing in property at this point in time, like for investment properties, or you think like we've capped out, or like, yeah, what do you think? What do you think?
That's a good question. It's a similar time to COVID, right? So understand you're having a good strategy to underpin why they're investing, but there is a big opportunity in the market at the moment, probably more locally than there is anywhere else in the country. So in my personal world, absolutely, I'm very aggressive at the moment because we're in a time where there is some uncertainty. Fast track 6 months, potentially 12 months. Once interest rates stagnate and then come off, I think we're going to see a surge of activity locally here in WA. We're going to have East Coast investment because our rental yields are so high, competing with local buyers. We haven't seen that yet. The first surge of growth post-COVID was really local owner-occupiers that drove a lot of that market, competing with some local investment. Phase 2, we're going to start to see East Coast investment coming in and quite significant. You listen to any property podcast nationally or on the East Coast, they're all very pro-Perth now for the first time, really ever. I haven't heard so many people speak so fondly about the data locally. First time through this year. So once there's confidence in the market, we're going to be competing with a lot of buyers, which is going to drive values. So I think the opportunity in the market is probably in the next 6 months, maybe 9 months. I think after that, we're going to start to get a market's going to be really competitive. So if you're going to do anything over the next 12 months, I'd probably look to bring that forward where you can buy in a market that's less competitive than you will in 12 months' time.
And I know in the past, like we've sent clients through to you to help find properties. You mentioned before about off-market purchases. Can you just touch on that, how that looks like? Obviously, so a client would come to you and you'll do a data analysis and go, look, we think these areas are hotspots. Let us find a property that if it's going to be investment or if it's going to be home, you'll go out and knock on doors and find a property for people.
Yep. No, so if it's in the investment space, obviously we'll deliver the advice, and that's going to be based around our 37 buy suburbs, based on the micro data, due diligence program, etc. So but in that space as well, we're buying 70% of the stock we're purchasing is off market. And in an occupier space, it's slightly different, right? Because you've got a client that wants to live in Subiaco or Cottesloe or Swanbourne, Peterbilt. So then it becomes very specific around their requirements, their personal requirements, what they're looking to purchase, their budget. But then the same process of sourcing properties remains the same, and that's getting opportunities where we don't have to compete, and that's in the off-market space. So leaning heavily on our agent relationships to get off-market stock, pre-market stock, as well as rental properties in that space. We target rental properties. Might be an East Coast investor that's held a property for 10 years. We can bring about an opportunity to buy that off them directly. We will door knock once we refine the brief specifically to go to spec to vendors or owners directly, take out the sales agents in those equations. So there's different avenues that we activate to purchase off market. But it's simple. Every result that we've been able to produce in the off market space is correlated with a sale on the street, which really just highlights, I suppose, the power of buying off market, because there's often significant savings in that space. Yeah.
Great. And am I right in saying, just based on what you've said tonight, from my point of view, like my clients are not feeling the pressure. They're probably hearing a lot in the media, and a lot of their patients would be feeling the pressure, in different industries, like the flow through of rates increasing, cost of living increasing. So if people are feeling a little bit uncertain and all of a sudden feel like they want to sell their investment properties, from what you've said, am I right in saying it's not a good time to sell? Like you're better off holding?
Yeah, look, it's case by case. Yeah, so absolutely speak to us. We can do a portfolio review on your portfolio. Speak to obviously your lender to get some comfort. But around that, we can give buyer wholesale recommendations. My concern with selling now, you're selling in uncertainty. When you're selling a market that's uncertainty, you're going to get a discount, natural discount. That's why we want to be buying in this market where we can buy for a discount, not sell. So there's always things that can be done typically, and you'd see it, Ali, where the first point of call doesn't necessarily need to be a sell. Where else can we relieve some stress? And that may be increasing rents, reducing some fees, speaking to your property manager to say, look, can we put a pause on management fees for 12 months while I get through this period? If your property manager won't do that, there's other providers that will. So it's just trying to relieve some stress on your portfolio as a first point of call, because we don't want to be selling if you've got quality properties in your portfolio. The entry costs and the exit costs are too significant, because this window of uncertainty, this window of high cost of money may be very short-lived. And what's happened in America last week, I think it's going to be a lot short-lived than we expect.
Yeah. Okay, good. They're all my questions. I don't know if there's anyone else who wants to ask anything.
Anyone want to jump in? Happy to throw it in the chat box if you need, if you don't want to jump on and ask directly. But if not.
While we're waiting, I thought I'd just quickly give a little mention just from my side of things. Obviously, Credible look after doctors and dentists with all their finance needs. On the home loan side, we can get loans up to 90% without mortgage insurance. So that's even for investment properties. So if you are thinking of jumping on the investing bandwagon, you only need to come up with a 10% deposit and your stamp duty. So always happy to run those numbers. And then on the home loan side, we can go up to 95% without mortgage insurance. So you only have to come up with a 5% deposit. So that's my little plug. I don't think any questions have come through, so we can wrap it up. And if you want Lockie's details, please reach out to me, or we can maybe send them out afterwards, just so you have them, or they're on the screen.
Yeah. Those that just jumped on, I think Jackie just jumped on, we'll send the video out as well. Ellie, I'll get that to you, and then you can
Okay.
check that. So,
Sounds good. Thank you so much, Lockie. That was amazing.
have a lovely night. See you
All
guys.
right. Thanks, guys. Bye.
Bye.